USD/SGD is the forex quote for the US dollar versus the Singapore dollar. In this quote, the value of $1 is expressed in terms of the Singapore dollar. For example, if the USD/SGD exchange rate is 1.33, it means that $1 can buy 1.33 Singapore dollars. The Singapore dollar is one of the most stable currencies in the world. According to FXSSI, a forex sentiment analysis website, the Singapore dollar ranked among the top 10 world's most stable currencies in 2023. The Singapore dollar has historically served as a speculative investment haven for traders, as Singapore has had relatively high interest rates, higher growth rates, fewer capital controls, and less developed labor markets. This unique combination of traits for the Singapore dollar makes it a particularly appealing investment currency. The USD/SGD pair is popular among risk-averse traders because it offers low volatility and steady returns. The US dollar is the world's reserve currency and the most traded currency in the forex market. The US dollar is influenced by various factors, such as economic data, monetary policy, and geopolitical events. The Singapore dollar is closely linked to the Chinese yuan, as China is Singapore's largest trading partner. The Singapore dollar is also affected by the performance of other Asian economies, such as Japan and South Korea. The USD/SGD pair tends to move in a range-bound manner, with occasional spikes or dips caused by major events or news. The pair is also sensitive to the difference in interest rates between the US and Singapore. A higher interest rate in the US would make the US dollar more attractive and push the USD/SGD pair up, while a lower interest rate in the US would have the opposite effect. The pair is also influenced by the demand and supply of both currencies in the global market. To trade USD/SGD successfully, traders need to pay attention to both technical and fundamental analysis. Technical analysis involves using charts, indicators, and patterns to identify trends and potential entry and exit points. Fundamental analysis involves studying the economic and political factors that affect both currencies and their relative value. Traders also need to be aware of the risks involved in trading forex, such as leverage, margin calls, slippage, and liquidity issues. In conclusion, USD/SGD is a currency pair that represents the exchange rate between the US dollar and the Singapore dollar. It is a popular pair for risk-averse traders because it offers low volatility and steady returns. However, traders need to be careful of the factors that can affect both currencies and their movements in the forex market. The USD/SGD exchange rate is influenced by many factors, but some of the most important ones are interest rates, inflation, trade balance, and geopolitical events. Let's discuss each of these factors in more detail. Interest rates are the cost of borrowing money. When interest rates are higher in one country than another, investors tend to move their money to that country to earn higher returns. This increases the demand for that country's currency and makes it appreciate. For example, if the US Federal Reserve raises its interest rate, while the Monetary Authority of Singapore keeps its interest rate unchanged, the USD will likely appreciate against the SGD. Inflation is the general increase in the prices of goods and services over time. When inflation is higher in one country than another, it erodes the purchasing power of that country's currency and makes it depreciate. For example, if Singapore has a higher inflation rate than the US, the SGD will likely depreciate against the USD. Trade balance is the difference between a country's exports and imports. When a country exports more than it imports, it has a trade surplus. This means that it earns more foreign currency than it spends, which increases the demand for its own currency and makes it appreciate. For example, if Singapore has a trade surplus with the US, the SGD will likely appreciate against the USD. Geopolitical events are events that affect the political and economic stability of a country or a region. They can have a positive or negative impact on a country's currency, depending on how they affect its growth prospects, risk appetite, and investor confidence. For example, If there is a war or a terrorist attack in Singapore or the US, it could create uncertainty and fear in the markets, which could make investors sell their SGD or USD assets and seek safer havens. As you can see, there are many factors that affect the USD/SGD exchange rate, and they can change over time. Therefore, it is important to keep an eye on these factors and their trends when trading USD/SGD in a risk-averse market. In this section, I will share some strategies and tips for trading USD/SGD in a risk-averse market. A risk-averse market is one where investors are more cautious and less willing to take on risk, which can affect the volatility and liquidity of currency pairs. Trading USD/SGD in such a market requires careful planning and risk management techniques to protect your trading profits and avoid losses. One strategy that can help you trade USD/SGD in a risk-averse market is using technical analysis. Technical analysis is the study of price movements and patterns on charts, which can help you identify trading opportunities and signals. For example, you can use trend lines, support and resistance levels, moving averages, and indicators to determine the direction and strength of the USD/SGD trend, as well as potential entry and exit points. Technical analysis can also help you set realistic price targets and stop-loss orders, which are essential for managing your risk. Another strategy that can help you trade USD/SGD in a risk-averse market is using stop-loss orders. A stop-loss order is an order that automatically closes your position when the price reaches a certain level, which can limit your losses if the market moves against you. Stop-loss orders can also help you preserve your capital and free up your margin for other trades. However, you should be careful not to set your stop-loss too tight or too far from your entry point, as this can either trigger your order too soon or expose you to too much risk. A good rule of thumb is to use longer-term moving averages for more volatile stocks to reduce the chance that a meaningless price swing will trigger a stop-loss order to be executed. A third strategy that can help you trade USD/SGD in a risk-averse market is hedging. Hedging is a technique that involves taking an opposite or offsetting position in another market or instrument, which can reduce your exposure to currency risk. For example, if you are long USD/SGD, you can hedge your position by shorting another currency pair that is highly correlated with USD/SGD, such as Euro to US dollar or Pound sterling to US dollar. This way, if USD/SGD falls, your loss will be partially offset by your gain in the other pair. However, hedging also comes with some drawbacks, such as increased costs, reduced profits, and complexity. A fourth strategy that can help you trade USD/SGD in a risk-averse market is diversification. Diversification is a strategy that involves spreading your risk across different markets or instruments, which can reduce your overall exposure to currency risk. For example, instead of putting all your money into USD/SGD, you can allocate some of it to other currency pairs that have different characteristics or drivers, such as Australian dollar to US dollar or US dollar to Japanese yen. This way, if USD/SGD performs poorly, your portfolio will not be affected as much by its fluctuations. However, diversification also has some limitations, such as lower returns, correlation risk, and opportunity cost. These are some of the strategies and tips that can help you trade USD/SGD in a risk-averse market. Remember that trading in any market involves risk, and you should always have a clear plan and strategy before entering a trade. You should also assess your risk tolerance and long-term financial goals regularly, and choose the right trading products that suit your needs. By applying these techniques, you can increase your chances of success and enjoy trading USD/SGD in a risk-averse market.